how to profit from the Fed's interest rate cuts. Stop relying on hearsay and making reckless moves. This video delivers pure, actionable insights. We'll break down the asset rotation logic across the entire rate cut cycle using official authoritative data. We'll spell out exactly what to buy and what pitfalls to avoid at every stage, from risk hedging to value appreciation. 3 tailored asset allocation plans for different risk appetites. You can follow these templates directly. Whether you're a novice or a seasoned investor, you'll walk away with a clear investment strategy. Keep listening. First, let's clarify a common misconception. Many claim the Fed started cutting rates in September, but that's not the full story. According to the Fed's official resolutions, September 2025 only kicked off the rate cut cycle. By December, the Fed had slashed rates by a total of 75 basis points. After the third rate cut on December 11th, the federal funds rate target range stood at 3.50% to 3.75%. So why cut rates? The core driver is a cooling labor market. Data from the U.S. Bureau of Labor Statistics shows that U.S. non-farm payrolls grew by just 73,000 jobs in August 2025, and the unemployment rate climbed to 4.6% by November, a clear sign of a slowing labor market. But don't panic just yet. The IMF's January 2025 report revised its U.S. full-year GDP growth forecast upward to 2.7% to 0.5 percentage points higher than its previous projection. This indicates the U.S. economy is still growing, just at a slower pace. In his December press conference, Fed Chair Jerome Powell emphasized that this rate cut cycle is designed to prevent weak employment from dampening consumer spending and avoid an economic stallnout because the economy is already in recession. That said, rate cuts themselves are an unambiguous signal of slowing economic growth. Mark this down as a critical takeaway. Next, let's look at historical patterns. Securities Times analyzed 4 Fed rate cut cycles since 2000. January 2001 to June 2003, September 2007 to December 2008, August 2019. To March 2020, September 2025 to present. All 4 cycles were triggered by economic slowdowns or easing inflationary pressures. And the market reaction to the 2025 rate cuts perfectly aligns with historical trends. In the month following the December rate cut, the S&P 500 index dropped 4.2%, confirming that markets tend to swing wildly in the short term after rate cuts. For more concrete data, in 56.25% of cases, 18 out of 32 instances since 2000, the S&P 500 and Dow Jones Industrial Average fell on the day of a rate cut. After the first rate cut in September 2007, the S&P 500 plummeted over 20% in 3 months. The emergency rate cut in March 2020 even triggered multiple circuit breakers in U.S. stock markets. These historical lessons still hold true today. You might be wondering, why don't markets rally immediately after rate cuts? The core reason is simple: monetary policy works with a lag. The IMF's 2025 research confirms this. Changes in interest rates take time to filter through to corporate and household borrowing and savings. Rates and corporate earnings don't improve overnight just because rates are cut. Adding to the uncertainty, there's massive disagreement over whether the Fed will cut rates further in 2026. The Fed's dot plot shows that among 19 policymakers, 7 favor holding rates steady, 3 support rate hikes, only 1 advocates for a sharp 150 basis point cut. This suggests the Fed will likely cut rates just once in 2026, at most. Another risk to watch is the impact of tariffs on inflation. U.S. Bureau of Labor Statistics data shows that U.S. CPI rose 2.9% year-over-year in August 2025, up from 2.7% previously. Tariff-sensitive core goods such as furniture and transportation products drove 0.4 percentage points of that increase. Persistent inflation could limit the Fed's ability to cut rates further. For everyday investors, this is the golden rule. Never go all in on the day of a rate cut. The market reaction after the December 2025 rate cut proves that the 1 to 3 month window following a rate cut is typically a period of volatility. Stay calm, use this time to build positions in batches, and don't get swept up in market euphoria. Also, keep a close eye on upcoming inflation data, employment figures, and Fed personnel changes. Chair Powell's term ends in May 2026, and future policy independence could be influenced by political factors, adding another layer of uncertainty. Now, let's dive into the part you've been waiting for: how to allocate assets during a rate cut cycle. There's a clear, stage-specific playbook here, backed by IMF research. The order of asset performance is driven by shifts in market liquidity, economic expectations, and investor risk appetite. Phase 1. 3 months before rate cuts. Hedge risk first. Funds flock to safe haven assets like gold and short-term treasury bonds as uncertainty mounts ahead of rate cuts. The 2025 market performance perfectly illustrates this trend. International gold prices surged from $1,900 per ounce to $300 per ounce, a 20% plus gain. U.S. short-term treasury bond yields fell from 4.5% to 3.8%, pushing bond prices higher. Historical data tells the same story. Gold rose 12% in the 3 months before the 2007 rate cut, while short-term treasury yields dropped 0.8 percentage points. Gold gained 15% in the 3 months before the 2020 rate cut, with short-term treasury yields down 1.2 percentage. Phase 2. 6 to 12 months after rate cuts chase stable returns. The market's focus shifts from risk hedging to steady income, and high-dividend blue-chip stocks and consumer staples outperform the broader market. The economic backdrop here is key. After rate cuts take effect, economic slowdown signs become more pronounced. Consumers cut back on discretionary spending, but demand for essential sectors, food, healthcare, utilities remains resilient, supporting stable corporate earnings. High-dividend stocks offer reliable cash flow, making them defensive powerhouses in weak economic times. Looking back at the 2020 rate cut cycle, the U.S. utilities sector delivered an average annualized return of 15%, far outpacing the S&P 500's 8%. High-dividend blue chips like Coca-Cola and Johnson & Johnson had half the volatility of the overall market, with dividend yields consistently between 3% and 5%. The 2025 post-rate cut trend mirrors this. By the end of December, the S&P 500 Consumer Staples Index rose 8%, compared to a 5% gain for the broader S&P 500. The S&P 500 High Dividend Index climbed 7.5%, outperforming the market handily. Investment strategy for this phase: avoid economic downturn risks while locking in steady returns. Choose ETFs or individual stocks of companies with stable operations, strong cash flow, and high dividend payouts. Phase 3. 1 to 2 years after rate cuts. Growth stock recovery. As rate cut effects fully take hold, liquidity improves, corporate financing costs decline, and earnings start to rebound, paving the way for tech stocks and small-cap growth stocks to outperform. But a critical caveat: not all growth stocks will rally. Only high-quality companies with low debt, strong cash flow, and proprietary core technology will thrive. The 2020 cycle is a perfect example. Tech giants with low debt and robust cash flow, Apple, Microsoft, saw stock prices rise twice as fast as small-cap tech firms. Highly leveraged small-cap companies without competitive advantages struggled with operational pressures and stagnant stock prices. Industry data from 2020 shows that The Nasdaq Semiconductor Index jumped 60% in the 1 to 2 years after rate cuts. The S&P 600 Small Cap Growth Index gained 45%, but highly leveraged companies in the index only averaged a 20% return, well below the sector average. We haven't reached this phase in 2025 yet, but markets are already positioning for it. By the end of December, loaded tech stocks in the Nasdaq 100 index rose an average of 10%, outperforming the index's 7% overall gain. This signals the Phase 3 playbook is already in motion. Now, let's highlight 3 critical investment pitfalls to avoid all stem from misinterpreting market dynamics or blindly following so-called authoritative investors. Pitfall 1. Blindly copying Warren Buffett's cash hoard strategy. Many investors see Buffett's cash reserves and rush to sell stocks and hoard cash, completely ignoring the capital scale gap. According to Berkshire Hathaway's 2025 mid-year and Q3 reports, cash and cash equivalents stood at $100.486 billion in mid-year, falling to $76.306 billion in. This is a far cry from the $347 billion figure circulating online. Buffett hoards cash because his capital base is massive. He needs undervalued targets worth tens of billions of dollars, which are scarce in today's U.S. market. For everyday investors, however, capital sizes are typically between $100,000 and $1 million RMB, perfect for targeting small-cap, undervalued gems that Buffett can't access, such as new energy upstream and midstream companies caught in the recent market sell-off. Asian consumer ETFs. For example, a new energy midstream ETF had a price-to-earnings P/E ratio at the 10th percentile of its historical range by December 2025, with a 20% recent drop, clearly undervalued. An Indian consumer ETF trades at 24x P/E, below its historical average of 28x, offering strong investment value. Blindly hoarding cash like Buffett will only make you miss these opportunities. Pitfall 2. Overhyping tariff-beneficiary stocks. Don't fall for the myth that manufacturing and steel stocks are safe bets during rate cut cycles. The core problem for U.S. manufacturing isn't a lack of orders, it's sky-high production costs. Data from the National Association of Manufacturers (NAM) in 2025 shows U.S. manufacturing workers earn an average hourly wage of 21 to 38. In contrast, Chinese manufacturing workers earn roughly 6.3 per hour for 4 RMB, and Mexican workers $5-6 per hour. U.S. manufacturing wages are 3.3x higher than China's and 4.2x higher than Mexico's. Even with import tariffs, many U.S. companies still choose to offshore production to control costs and then import finished goods back to the U.S. Let's correct a common misconception. Claims that U.S. steel stocks fell 25% in 2025 are factually incorrect. Thanks to the Trump administration's tariff policies and partnerships with Nippon Steel, U.S. steel's stock price surged 21% in a single day in May 2025, hitting a 14-year high for the year. But this rally was driven by short-term policy stimulus, not fundamental industry improvements. U.S. Bureau of Labor Statistics data shows that U.S. manufacturing employment fell from 12.76 million at the end of 2024 to 12.72 million in December 2025, a 40,000-person decline for the year. Tariff policies fail to boost manufacturing jobs. Research from the Peterson Institute for International Economics further confirms that tariff costs are ultimately passed on to U.S. consumers. Tariff revenue reached $194.9 billion in fiscal 2025, providing minimal fiscal benefit while fueling inflation. The long-term investment case for tariff-beneficiary stocks simply doesn't hold water. Pitfall 3. Overconcentrating on U.S. dollar assets. Don't overlook the dual benefit opportunity of non-U.S. dollar assets. stock price appreciation plus currency appreciation. Let's start with some eye-opening data. U.S. national debt has ballooned to $37.9 trillion. As of October 2025, debt-to-GDP ratio exceeded 130%, with annual interest payments surpassing $1 trillion. The U.S. dollar's status as the global reserve currency is eroding. In contrast, emerging markets like India and Vietnam are brimming with economic vitality. Vietnam General Statistics Office data released January 5, 2026 shows that Vietnam's GDP grew 8.02% year-over-year in 2025, with Q4 growth hitting 8.46%, the highest quarterly rate since 2011. Vietnam's GDP reached $514 billion, with per capita GDP exceeding $5,000. India's 2025 GDP growth is projected at 7.5%, far outpacing the US's 2.7%. These emerging markets have debt-to-GDP ratios just one-third of the US's. With healthier fiscal positions and stock markets trading at historically low valuations. Compounding the upside, the US dollar index has fallen 5% since 2025, with an 8% full-year drop expected. The Indian rupee has appreciated 3% against the dollar, and the Vietnamese dong is up 2.5%. As the dollar weakens further, emerging market currencies have room for additional gains, unlocking dual returns from stock price and currency appreciation. For example, India's Nifty 50 Index ETF delivered a total return of 19.5% in 2025. 16% from stock gains plus 3% from currency appreciation. Vietnam's VN30 Index ETF returned 20.9%. Both far outperformed the S&P 500's 5% full-year gain. Overconcentrating on US dollar assets not only fails to diversify risk, it also makes you miss out on the high-growth potential of emerging markets. Next, we'll outline 3 differentiated asset allocation plans, tailored to different risk tolerances and backed by historical data. Plan 1, Conservative Allocation. Ideal for investors aged 50+, low risk tolerance, seeking stable returns. Core principle, safety first, with modest returns as a bonus. Allocation ratio based on mainstream market ETF strategy models. Short-term treasury bonds, money market funds, 40%. High-dividend blue-chip ETFs, 30%. Gold ETFs, 20%. Consumer staples ETFs, 10%. Rationale. Short-term treasuries and money market funds offer 3 to 4% annualized returns with nearly zero credit risk. Money market funds allow instant redemptions, acting as a capital safety net. High-dividend blue-chip ETFs tracking indices like the Dow Jones U.S. High Dividend Index deliver 6 to 8% annualized dividend yields with minimal volatility, up 7.5% on average in 2025. Gold ETFs hedge against inflation and market risk, rising 20% in 2025 to reduce overall portfolio volatility. Consumer staples ETFs tracking the S&P 500 Consumer Staples Index focus on recession-resistant sectors like food, beverages, and healthcare, up 8% in 2025, providing portfolio stability during economic downturns. Implementation strategy, monthly dollar cost averaging DCA. Trim gold ETF positions by 50% if prices rise over 10%. Add 50% to positions if prices fall over 10%. Reinvest dividends automatically. Backtest data, 5.8% annualized return over the past 10 years. With a maximum drawdown of just 8%, perfect for conservative investors. Plan 2, Balanced Allocation. Ideal for investors aged 30 to 50, with moderate investment experience, willing to tolerate 10 to 20% portfolio volatility. Core principle, balance stability and growth. Reduce risk through diversification. Allocation ratio, low-cost broad market ETFs, 35% high dividend ETFs plus utilities ETFs, 25% emerging market ETFs, 15%. Gold plus short-term treasuries, 20%. Low debt small cap stocks, 5%. Rationale: broad market ETFs, for example, VTI tracking the S&P 500. QQQ tracking the Nasdaq 100 offer low fees. VTI has a 0.03% expense ratio and steady returns. VTI gained 5% in 2025, with a 9.21% annualized return over the past 10 years. High dividends and utilities ETFs provide stable cash flow, up 7.5% on average in 2025, acting as portfolio anchors. Emerging market ETFs, for example, a mix of India's Nifty 50 and Vietnam's VN3 ETFs, offer high growth potential, up 16% on average in 2025 with a low 0.3 correlation to U.S. stocks, effectively diversifying risk. Gold and short-term treasuries, 20% hedge against inflation and geopolitical risk. Low debt small cap stocks, asset to liability ratio 30%, positive cash flow for 3 consecutive years at alpha, up 12% on average in 2025. Implementation strategy: combine regular DCA with opportunistic buying on dips. Trim broad market ETF DCA contributions by 30% if the S&P 500 rises over 5%. Increase contributions by 50% if the index falls over 5%. Review emerging market ETF holdings quarterly based on economic data. Set a 15% stop loss and 30% take profit level. Backtest data: 8.2% annualized return over the past 10 years. With a maximum drawdown of 15%, striking a perfect balance between stability and growth. Plan 3. Aggressive allocation, ideal for investors under 30, high risk tolerance, chasing high returns. Core principle: embrace growth, trade higher volatility for higher rewards. Allocation ratio: tech ETFs, 30%, small cap growth ETFs, 25%. Emerging market individual stocks, industry ETFs, 20%. Gold plus cryptocurrencies, 15%. Cash, 10%. Rationale: tech ETFs focused on AI and semiconductors. Tracking indices like the Nasdaq Semiconductor Index deliver high growth, up 26% in 2025, with a 15.66% annualized return over the past 10 years. Small cap growth ETFs, for example, IJD tracking the S&P 600 Small Cap Growth Index, offer explosive potential, up 22% in 2025. Emerging market exposures, for example, Indian consumer ETFs, Vietnamese manufacturing ETFs, or high-quality individual stocks, capture high growth opportunities, up 18% on average in 2025. Gold 5% hedges against tail risks. Cryptocurrencies 10%, for example. Bitcoin act as high-risk, high-reward bets. Bitcoin rose 40% in 2025. But note its extreme volatility, maximum drawdown of 25%. 10% cash reserves serve as dry powder for opportunistic buying during market crashes. Implementation strategy: dynamic rebalancing. Trim tech ETF positions by 20% if prices rise over 15%. Add 30% to positions if prices fall over 20%. Set a strict 20% stop loss for cryptocurrency. Sell immediately if losses hit this threshold. Don't hold on hoping for a rebound. If the S&P 500 falls over 20%, deploy 50% of cash reserves in one go to capitalize on undervaluation. Let's take a deeper dive into emerging market opportunities. The dual benefits of stock and currency appreciation are backed by solid fundamentals. Indonesia, household consumption accounted for 53.14% of GDP in the first 3 quarters of 2025. Supported by strong fixed asset investment and robust exports to China and ASEAN, Indonesia's digital economy is projected to reach $99 billion in 2025, a 14% year-over-year increase. India, digital economy and manufacturing are the main drivers of 7.5% GDP growth in 2025. Southeast Asia, a joint report by Google, Temasek, and Bain & Company projects that Southeast Asia's digital economy will exceed $300 billion in 2025, a 16% year-over-year growth rate. This economic dynamism is the foundation for asset appreciation. From a valuation perspective, emerging market stocks offer compelling value. As of December 2025, India's Sensex 30 index trades at 24x P/E. Vietnam's VN30 index at 18x P/E. And Indonesia's JKS index at 16x P/E, all at historically low levels. In contrast, the US S&P 500 index trades at 29.53x P/E, well above its historical average of 21x. Capital flows further confirm the trend. Global capital inflows into emerging market equities reached $230 billion in 2025, a 45% year-over-year increase. India attracted $80 billion and Vietnam $50 billion. Sustained capital inflows will drive stock prices higher. This dual return dynamic is already proven. India's Nifty 50 Index ETF, 19.5% total return. Vietnam's VN30 Index ETF, 20.9% total return. Indonesia's JKS Index ETF, 16.3% total return. All far outperform the S&P 500's 5% full-year gain. What's more, emerging markets have a low correlation with U.S. stocks, making them effective portfolio diversifiers. The IMF's World Economic Outlook even recommends increasing emerging market asset allocations. Don't miss this opportunity as US dollar asset risks mount. Finally, let's distill 3 core investment principles to achieve steady, long-term growth while protecting your principal. Principle 1. Diversify your portfolio. Modern portfolio theory MPT by Harry Markowitz proves that allocating capital across low correlation assets reduces volatility without sacrificing returns. 2025 data shows that a globally diversified portfolio had a maximum drawdown of just 15% for the year, compared to 22% for a US-only stock portfolio, while delivering the same 8.2% annualized return. Diversify across countries, sectors, and asset classes. Don't put all your eggs in one basket. Principle 2. Adopt a long-term mindset. Short-term market fluctuations are just noise over the long run. Stock markets always trend upward. Consider these data points. S&P 500 index, 10% average annualized return over the past 50 years, outpacing long-term inflation 3 to 4%. India's Nifty 50 index, 12% average annualized return over the past 20 years. Vietnam's VN30 index, 14% average annualized return over the past 10 years. From a holding period perspective, S&P 500, 85% probability of positive returns over 5 years, 95% over 10 years, 100% over 20 years. India's Nifty 50, 88% probability of positive returns over 5 years, 96% over 10 years. Vietnam's VN30, 86% probability of positive returns over 5 years, 97% over 10 years. The power of compounding is staggering. If you invest $1,000 per month with a 10% annualized return, you'll have $206,000 after 10 years, $633,000 after 20 years, and $1.885 million after 30 years. Behavioral finance research further confirms that frequent traders underperform long-term holders by 4 to 6 percentage points. Annually, short-term market timing is the primary cause of investment losses. Stay focused on the long term to ride out market cycles. Principle 3. Stick to disciplined investing. Turn investment logic into action with 3 rules. dollar cost averaging DCA, dynamic rebalancing, and strict stop-loss take-profit levels. DCA spreads out your entry points, reducing the risk of buying at market peaks. Backtests show that monthly DCA into the S&P 500 from 2010 to 2020 delivered a 9.8% annualized return, compared to just 5.2% for investors trying to time the market. Dynamic rebalancing. Adjust allocations based on valuations. Trim stock holdings by 10 to 15% if the S&P 500 P/E ratio exceeds 30x historical high. At 10 to 15% if it falls below 15x historical low. Stop loss take profit. Enforce strict rules based on risk tolerance. Conservative investors. 15% take profit, 8% stop loss. Balanced investors. 25% take profit, 15% stop loss. Aggressive investors. 30% take profit, 20% stop loss. Historical data shows that investors who stick to these rules reduce maximum drawdowns by over 50% and boost annualized returns by 3 to 4 percentage points. Buffett's success isn't about timing the market, it's about respecting valuations, waiting patiently, and holding for the long term. Apply these 3 core principles to your investments, and you'll navigate complex market environments with confidence and grow your wealth steadily. That's all for today's video. If you found this content useful, like, subscribe to my channel, and hit the notification bell. I'll notify you the moment I release new market analysis. Leave your questions in the comments section below, and I'll answer every single one. See you next time.